For people looking to break into commercial real estate, acquisitions analyst roles are some of the most sought after positions in the entire real estate industry. Acquisitions is arguably the most exciting piece of the entire commercial real estate business, where you'll see different properties and markets every single day, and you'll also have a direct impact on the investment decision making process. An acquisitions analyst can have a bunch of different roles, but one of the most important responsibilities that an analyst is going to have is acquisitions underwriting, essentially using or building a pro forma financial model to value commercial real estate deals. But unlike residential real estate, the commercial real estate valuation process isn't just based on comparable sales, but instead, commercial properties are valued primarily based on the income they can generate, which has a lot of moving pieces. So in this video, to demystify the real estate underwriting process, let's break down exactly what acquisitions underwriting is, what an acquisitions or investment analyst will be responsible for when underwriting a deal, and how this underwriting ends up being used to ultimately value commercial real estate properties. So as a real estate acquisitions analyst, your job is exactly what it sounds like: to analyze and value commercial real estate properties that your company is looking to acquire. And to run this analysis, the first step in this process is getting access to data on the property by signing a confidentiality or non-disclosure agreement, essentially saying that you won't share the property's confidential information with any outside third parties. And once you've signed that NDA and you've been approved by the broker, at this point, you'll have access to what's commonly referred to as the war room. The war room is really just an industry term used to describe a shared data center that holds all the key downloadable information on the property, and this is where the majority of the information you'll need for underwriting purposes is going to live. And the first key piece of information that's going to be included in this war room is one of the most important documents you'll need to underwrite a deal, and that is the in-place rent roll. The in-place rent roll is really just a list of all multifamily units and commercial suites at the property, both occupied and vacant, and this is going to clearly show the in-place rent each tenant is currently paying, any rent escalation schedules for long-term commercial leases, any ancillary charges for things like storage or parking, any expense reimbursement structures for commercial tenants, and the start date and end date of all in-place leases. The rent roll is really going to serve as the foundation for your underwriting, since this is the in-place contractual income stream being generated, which isn't going to change as soon as you acquire the deal. Now, to round out your revenue-related data and to give you an idea of expenses at the property, the second critical piece of information that you're going to get access to within this war room is going to be the historical income statement on the property, often referred to as the T12 or trailing 12-month financials. The T12 is going to be really helpful in showcasing property operations over the last year and is going to clearly show things like rental revenue generated, vacancy and credit loss, ancillary income drivers, and operating expenses incurred by the seller. Now, obviously, every investor will operate a deal a little bit differently, and you'll usually need to make your own assumptions about things like property management fees, insurance rates, and property tax reassessments, but the T12 is usually going to give you a pretty good sense for what the operations currently look like at the deal and what operations might look like for you if you did acquire the property. Now, along with the rent roll and the T12, for commercial deals with long-term in-place leases, it's really important to dig into the details of these leases themselves, which leads me to the third key piece of information that you'll usually see in the war room: the actual lease document. The main job of a listing agent is to maximize pricing for the seller, and although most brokerage firms will honestly try to be as accurate as possible with their underwriting, it is ultimately on you as a potential buyer to verify all information provided. As an analyst working on retail, office, or industrial deals, lease review can be one of the most tedious parts of the entire underwriting process, but to make sure you catch the little things like expense reimbursement caps, options to renew, and future free rent periods that will have a very real impact on the economics of your deal, This is unfortunately a necessary step. Now, if these three documents are all that are provided to you, this is usually still enough to get started, but to help make your workflow even more efficient, many brokerage firms will also add 2 additional files to the war room that can make the underwriting process significantly easier. For retail, office, and industrial properties, one of the most difficult and time-consuming pieces of building out your analysis is commercial real estate lease modeling, which is why the first of these 2 additional documents is usually going to be an Argus file. If you aren't familiar with Argus, Argus is a real estate financial modeling software that's used primarily by commercial real estate firms investing in retail, office, or industrial property. Argus makes it easy to input lease information into the software, but Argus also makes it easy to export an Excel document reflecting the cash flows that the property is expected to generate, which can then be integrated into a company's proprietary financial model where you, as the analyst, will add things like your purchase price assumptions, debt assumptions, and sale assumptions on the deal. Now, similar to what I mentioned earlier, a listing agent's job is to maximize pricing for the seller. So as an analyst, your job is to go through this Argus file to verify lease information and dial in any operating and growth assumptions that might be a little aggressive, but overall, this makes the process a lot easier and gives you a starting point to work from. And finally, on top of the Argus file, the last key piece of information that brokers will generally upload to the war room puts together all the details of the rent roll, the T12, the leases, and the Argus file into a nice, clean, concise package, and that is the offering memorandum, or OM. The job of the OM is to clearly and cohesively tell the story of the property, including a detailed description of the market and submarket, the physical characteristics of the property itself, opportunities to create value for the next buyer of the property, and even pro forma cash flows based on the broker's projections. This is also where you'll usually get more guidance on things that might have been unclear when reviewing other documents in the war room. For example, detailed information on things like ground leases, inconsistent property tax bills, or even affordable rent restrictions that might limit the property's income potential in the future. Overall, these 5 things will be the main components of what you'll use for your underwriting, but as an analyst from here, the real work is just getting started. As a member of the acquisitions team, your job is not to just input information into a pre-built Excel model, but instead to take the information you've been given and identify patterns, trends, irregularities, and any other opportunities to increase revenue, decrease expenses, or improve operations when the property is acquired. This includes things like estimating capital needs to renovate the property, analyzing rents in the market for comparable deals, and analyzing in-place vacancy numbers and how these stack up against other properties in the market. This could also involve looking for opportunities to add ancillary income to the property with things like storage fees, parking fees, or amenity fees, estimating the property's expense load upon acquisition based on the financials of other properties in your portfolio, or doing research on what kind of loan product might be best for the type of deal you're analyzing and how debt can be used to optimize your return. And even though you're probably not going to know all of this information right off the top of your head, when you're working as part of a larger team, fortunately, you'll be able to leverage the experience of a handful of experts in your organization to help you make these assumptions. As an analyst, you'll constantly be collaborating with your finance and capital markets teams to dial in your debt terms. You'll be working with asset managers to get more clarity on construction costs, leasing, and expense assumptions, and you'll be working directly with the rest of your acquisitions team to get an idea of target pricing on the deals you're working on and an offer price you need to get to in order to be competitive. And with all of your assumptions now in place and everything added to your model, this is where you can finally finish up your underwriting by valuing the deal. Most real estate firms will value properties based on target returns, either those they've already promised to investors through a fund structure or those which they believe will be necessary to get investors interested in a one-off syndication. And the return metrics that real estate private equity firms are usually going to focus on most are the IRR equity multiple, cash on cash, or a mixture of all three of these metrics, and your job as the analyst is to find an offer price that will produce these minimum acceptable returns. And in a dynamic real estate financial model, finishing up the underwriting process is relatively easy at this point and really just involves adjusting your purchase price to get to a place where all return targets are hit, and from there, deciding whether or not it makes sense to put in an offer. Ultimately, the real estate underwriting process really comes down to putting together any and all information you can that's going to affect the economics of the deal, adding that information into a real estate financial model in Excel and or Argus, and then researching the market and collaborating with your team to make assumptions around future operations, including lease terms, rents and expenses, occupancy levels, construction costs, debt terms, and any other inputs that are going to affect your cash flows and ultimately your returns on the deal. And if you're looking for more detailed step-by-step training on the underwriting process, how to use a real estate pro forma to value commercial properties, and even how to build out a complete institutional quality acquisition or development template all from scratch in Excel on your own, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to our brand new Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that are going to help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on this channel on commercial real estate careers or insights into the life of an analyst, make sure to hit the like button and let me know. And let me know in the comments what type of career-related content you'd like to see covered on the channel next. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.